Credit coach Jeanne Kelly will get your client's rental rating on the credit report with a 2-year history that passes through all levels of FICO, makes it through DU and LP, and impacts your credit decision on your automated approval engines. Yeah, that's right. This could be a big swing in FICO score, meaning the difference between FHA and conventional, and certainly big pricing differences. So click the banner you see on your screen right here, right below the video, to engage with Jeanne Kelly and her team to get this done for your clients now.
And Frank actually missed the biggest one of all. It could be the difference between qualifying and not qualifying. This is really huge. So Biden's $15,000 homebuyer tax credit is now, well, it's a bill. Thank God, it's a bill. Just what this market needs. More buyers. I mean, seriously, whew! I was getting a bit concerned about the future of the housing market because it's beginning to look like we're running low on buyers. So thank God Biden and the brain trust in Congress accurately diagnosed the problem facing housing, which is clearly a shortage of buyers. And they decided to focus their outreach and our tax dollars on exactly where it was needed. You guessed it. More buyers.
Yep, that's right. That's what we need, Brian. More buyers.
More buyers!
So with that in mind, United States Representative Earl Blumenauer, Democrat from Oregon, and Representative Jimmy Panetta, Democrat from California, today introduced the legislation dubbed the First-Time Homebuyer Act. The bill would provide a tax credit for first-time homebuyers of up to 10% of the purchase price.
Woohoo!
Or $15,000.
Woohoo! And just to make sure we're all up to speed on this whole thing, there's another thing going on right now. Maxine Waters, she is spearheading the $25,000 giveaway for first-generation buyers. We covered it before. So here's the thing. If only these first-time home buyers would qualify under the congressionally mandated ability to repay under your qualified mortgage, which they cannot do because they don't make enough money to buy these overpriced homes in these overheated markets, then and only then would they be able to take advantage of the $15,000 and $25,000 giveaways, respectively speaking, of course. But that won't happen, you see, because you misdiagnosed the darn problem, didn't you? And are now allocating those funds for down payment assistance.
Everywhere you look, it's like there's no homes for sale. There's too many buyers and not enough homes. Let's get more buyers going!
Totally, that's exactly what's going on.
Here's how you know they misdiagnosed this whole thing. Seriously, they spell it out in their guidelines. Think about this. They are defining low and mod income as being 160% of the area median. 160% is not low or mod income. It's like mod high to high income, right? I mean, it's 160%. Okay, now, the same program says you can buy a home that's 110% of the median. Okay, that's about average. About. It's 110% of the sales price. So to put this program's guidelines into focus that we can all understand, here's what they're offering. A $15,000 tax credit made available to upper middle class or upper class folks to buy a home that doesn't exceed more than 10% above the area average. They did this because in order to buy an average home, you must have a decidedly above average income. And therein lies the problem.
You see, these type of legacy mindset policies have a strong history of not working and not serving the communities that we know need the most help.
And that's what gets under our skin, and probably yours too. For example, we know that in 2018, fewer than 5% of loans that the GSEs backed went to black borrowers, and less than 11% went to Latino borrowers. 77% went to white borrowers. So clearly, whatever we're doing to bridge the homeownership gap is not only not working, but could very well argue what we are doing is actually hurting. And we're not the only ones who see this, are we?
In order to put together these $25,000 and $15,000 bills, they have these things called listening sessions. And in one of these listening sessions, with the Enterprise Housing Goals Advance Notice of Proposed Rulemaking, Agatha So suggested that the FHFA publish data that enables them, policymakers, policymakers and the public to understand how the housing goals impact low income, and borrowers from communities of color. Which, to point, they're not doing, because if they did, they would see that what they're doing is not working.
But it does make sense, yes. Publish and track how these rules, bills, and policies truly affect those they're supposed to affect. Because as Jeanne Levi said in this very same session, we have expressed continued concern about the impacts of various FHFA conservatorship policies on the ability of the enterprises to respond to the scale of the affordable housing challenges facing the country, as well as their role in expanding access for borrowers of color and in addressing the racial wealth gap are longer common goals into some of the policies over the years that have affected the ability of the enterprises to carry out their mission and meet their housing goals and other obligations.
So they're concerned that the FHFA and the GSEs are overwhelmed right now. That would kind of make sense. Little tracking would help, wouldn't it? See, and what we are suggesting is addressing the housing and subsequent wealth gap, not by financing overpriced properties, but by building the more affordable properties.
Wouldn't that be a grand idea?
Yeah.
But you guys do us a favor, man. Leave us your comments down below. Share this on Facebook. Subscribe if you're meeting us for the first time. We'll come at you every day. And we'll catch you guys tomorrow here on the National Real Estate Post. Adios.